Welcome to the deep dive. Today, we're really diving into a set of sources you shared with us, focusing on Applied Digital Corporation, that's APLD, and this, well, frankly, massive data center deal they've signed with CoreWeave. Applied Digital, they've been around in digital infrastructure, but this contract feels like a whole different level. Everyone's calling it a game changer, but what's really going on behind those headlines for APLD?
It really is more than just a big contract. It feels like a potentially transformative pivot for them, right?
Ooh.
Pushing them hard into the high-performance computing or HPC and AI infrastructure space. That's a market needing huge power, specialized buildings, stuff like that. So our job today, looking at these articles, the research notes, the SEC filing summaries you sent over, is to really unpack it all, understand the numbers, the implications, both the good and the potentially bad, and figure out what you really need to watch going forward.
Okay, let's get into it then. Applied Digital puts out this announcement, these agreements with CoreWeave, and the number that jumps out is huge, $7 billion.
That's the headline number, yeah. And the scale is fascinating, but it's crucial to understand. This isn't $7 billion hitting their bank account tomorrow. It's the total expected revenue they think they'll get from 2 specific data center leases. These are at their campus up in Ellendale, North Dakota.
$7 billion.
Yeah.
Okay, but over what kind of time frame are we talking?
Right. The sources state this revenue gets recognized over the initial term of each lease, and that term is roughly 15 years. So yeah, spread out over quite a while.
Got it. 15 years, so not immediate cash, but a long-term stream. If you average that out, what does it look like annually, just to get a feel for the yearly impact?
Yeah, good question. If you take that $7 billion over about 15 years, it averages out to roughly $467 million per year. So that provides a pretty substantial and, importantly, a predictable long-term recurring revenue stream, something they haven't really had at this scale before.
Wow, $467 million a year. That definitely adds predictability.
Yep.
And this deal, how much actual data center space or power does it cover?
It covers a total of 250 megawatts MW of critical IT load. Think of megawatts as just the power capacity needed for all the computers. Specifically, there are 2 buildings involved at Ellendale. Building 2 is 100 milliW, and that's expected to bring in about $3 billion of the total revenue. Then there's Building 3, the bigger one at 150 milliW, and that's projected to generate around $4 billion, both over that same roughly 15-year term.
Okay, so 250 megawatts total to start, split between 2 buildings, driving that $7 billion figure over 15 years. Compared to where APLD has been, this feels genuinely massive.
It absolutely is massive. And with that size comes some really significant obligations for Applied Digital. Under these lease agreements, their main job, their primary responsibility is to deliver that 250 milliW capacity. That means build it, get it running, and then they have to maintain what are called customary service levels, basically. High reliability for CoreWeave's intense computing needs.
Deliver the capacity. Okay, how fast do they need to do that? When do these buildings need to be ready?
And this is where, honestly, the biggest execution risk probably lies. APLD is contractually obligated to start providing services for the first building, the 100 MW one, Building 2, on specific dates during the second half of calendar 2025. The press releases consistently point to the 4th quarter of 2025 as the target.
Okay, so the first big piece needs to be operational pretty soon, end of this year, late 2025. What about the second larger building?
For Building 3, the 150 milliW facility, they have to start providing services on specified dates during the first half of calendar 2026. Again, press releases tend to mention mid-2026 as the goal.
So it's phased, late 2025, then mid-2026. What are the consequences if they, slip, if they miss those dates?
Yeah.
Construction delays happen, right?
This is maybe the most critical point in the sources. The documents indicate that if Applied Digital fails to satisfy certain installation and delivery requirements by that contractually specified date, and okay, there are some limited exclusions and procedural terms, the fine print isn't totally public, but if they fail, CoreWeave has the right to terminate the affected lease.
Whoa, terminate the lease. The whole thing.
Yeah.
The one bringing in $3 or $4 billion potentially.
Exactly. And critically, if CoreWeave terminates because APLD didn't deliver on time, CoreWeave's obligations just stop. And Applied Digital would apparently not receive any termination fee or any other payments for that specific terminated lease. So it really underscores financially how vital it is that they hit those construction schedules. The pressure is immense.
Yikes. Okay, that puts enormous pressure on their teams. Apart from APLD failing to deliver, does CoreWeave have other ways out of this deal?
They do. CoreWeave also holds the right to terminate the leases at any time just for its convenience.
They can just decide they don't need it anymore, mid-contract.
Yes, by providing notice. However, in that specific scenario, termination for convenience, CoreWeave is obligated to pay Applied Digital a specified termination fee. Now, how much that fee is or how it's calculated, that's not disclosed in the summaries we looked at.
Okay, so there is a fee if CoreWeave walks away just because, but apparently no fee for CoreWeave if APLD doesn't build it on time. That sounds like a pretty tough term for APLD. Did CoreWeave get anything else as part of this big agreement?
Yep. Tied into signing the leases, Applied Digital issued what's called an initial warrant to CoreWeave. This happened back on May 28th, 2025.
Warrants. So
Right.
CoreWeave gets shares, or the option for shares.
Basically, yeah. This warrant gives CoreWeave the option, the right, not the obligation to buy up to about 13 million shares of Applied Digital's common stock. The exercise price is set at $7.19 per share.
Interesting. Why would APLD do that? Give their tenant potential equity?
Well, it's a strategic tool you sometimes see in these big deals. The idea is to align CoreWeave's interests with Applied Digital's own stock performance. Gives CoreWeave a bit of skin in the game, an incentive. Helps foster a deeper partnership, potentially. But for you, as an investor looking at APLD, it represents potential future equity dilution. If and when CoreWeave exercises those warrants, it means more shares out there, which can reduce the value per share for existing stockholders.
Right. Dilution. Always something to watch. Did the main company, Applied Digital Corporation, guarantee these deals made by their subsidiaries?
Yes, they did. The parent company, Applied Digital Corp., provided a guarantee covering the contractual obligations of the specific LLCs that actually signed the leases. That's pretty standard stuff, gives the tenant, CoreWeave, extra security.
And did CoreWeave put out their own big press release about this? I mean, securing $250 million in the W is huge for them too, right?
You'd think so, but the sources we reviewed don't show that CoreWeave issued its own press release specifically about these leases right around the time APLD announced it on June 2nd. Seems like Applied Digital primarily drove the public announcement.
Okay, so huge contract, big obligations, serious delivery risks, warrants for the tenant. Let's switch gears to the upside now. How does landing a $7 billion contract like this really change the financial story for Applied Digital?
Yeah, this is where it gets really, really interesting. Because having this stable, very long-term revenue stream just fundamentally alters their financial landscape. The company itself talks about extraordinary visibility into their long-term finances. It dramatically changes their whole business outlook compared to just before the deal.
I could see that. $467 million average annual revenue brings a lot of visibility.
Yeah.
How big is that compared to where they were, say, last quarter?
Okay, check this out for context. In their last reported quarter, Q3 fiscal 2025, ending February 28th, Applied Digital's total revenue was $52.9 million. Now remember, that $467 million annual average from CoreWeave, that translates to roughly $116.75 million per quarter on average once both buildings are fully up and running.
Wait, hold on. The average quarterly revenue from just this one contract is projected to be more than double their total company revenue from the last quarter.
Exactly. Precisely. That really drives home the kind of transformative impact this is expected to have on their top-line revenue. It's a massive step change.
Okay, huge revenue boost. What about profitability? Are these AI data center leases generally high margin?
The sources don't give us specific margin percentages, unfortunately.
Yeah.
But the company does talk about the revenue per MW metrics reflecting premium economics. That's the term they use. Basically, they're saying providers who can handle the specific demanding needs of AI workloads can command better pricing.
And what contributes to those premium economics? Why are they potentially more profitable?
Well, a few things are mentioned. Access to low-cost power, like in North Dakota, is a huge factor. Power is a major operating expense. An energy-efficient climate helps reduce cooling costs. And critically, these are purpose-built facilities designed for high efficiency. They're targeting a really low power usage effectiveness, or PUE, of 1.17.
PUE. Remind me what that means again? Lower is
Yeah,
better.
exactly. PUE measures how much total energy the facility uses versus how much energy goes directly to the IT equipment, the computers. A perfect score is 1.0, which is impossible. 1.17 is considered very, very efficient. Lower PUE means lower energy operating costs, plain and simple. And that's a huge driver of data center profitability.
So lower operating costs combined with premium pricing for AI workloads suggests potentially strong margins. How does this impact their path to actually making money and generating cash flow? They've been investing heavily, right?
Right. Applied Digital has historically operated with net losses. They've been characterized as cash burning because building all this infrastructure costs a ton upfront. This stable, long-term, high-value recurring revenue from CoreWeave is expected to significantly accelerate their timeline to reach sustained profitability and consistent positive cash flow. It provides a foundational revenue base they really didn't have before at this scale.
Yeah, it feels like a major shift. Instead of building and hoping the contracts come, they now have the massive contract that justifies and, frankly, probably demands the investment. Did their market value before the deal reflect this kind of potential win?
It's interesting. Around early June 2025, when this deal was announced, Applied Digital's market cap, the total value of the company's stock, was about $1.53 billion. And the total projected lifetime value of this single contract, approximately $7 billion.
Wow, the contract value is almost 5 times the company's market cap at the time. That's genuinely eye-opening.
It really does highlight the sheer transformative scale of this single agreement for Applied Digital. But, building these massive facilities for CoreWeave and funding future growth, that takes an enormous amount of money.
All right, data centers aren't cheap to build. So how are they planning to finance all this construction? Where's the cash coming from?
It looks like a multifaceted approach, pulling from different kinds of funding sources. They recently announced a $150 million convertible preferred equity facility they can draw on. And then there's that strategic financing agreement they signed with McCory Asset Management, or AM, back in January 2025.
Yeah, the McCory Deal. I saw some online chatter mentioning $5 billion of additional funding in the bag. Is that accurate? Do they just have $5 billion sitting there from McCory?
This is a really key point to clarify from the sources. That $5 billion figure is not $5 billion of cash readily available today. It's a facility where MAM has the right, but not the obligation, to invest up to $5 billion over time. And it's contingent on certain conditions being met, like APLD actually securing executed leases, which, of course, this CoreWeave deal helps satisfy. It's potential access to capital tied to projects, not just cash on hand.
Okay, got it. So access to significant capital, but conditional, tied to milestones and specific projects like Ellendale. What other financing pieces are in play?
Well, they also closed a $300 to $75 million financing deal specifically with Sumitomo Mitsui Banking Corporation, SMBC, back in February 2025. That one is earmarked specifically to support the Ellendale development. And around the time of the CoreWeave announcement, they were also targeting a potential at-the-market, or ATM, offering, planning to potentially sell up to $200 million of their common stock.
An ATM offering, so selling new shares directly into the market.
Exactly. It lets them raise capital more gradually, provides liquidity for these big upfront construction costs. But like those CoreWeave warrants we talked about, it does mean more shares outstanding, which results in dilution for existing shareholders.
So we've got debt from SMBC and existing debt, potentially complex segment-level equity from Macquarie, convertible equity, and the possibility of selling more common stock through an ATM. That's a lot of moving parts on the funding side, with potential dilution baked in.
It is. The ATM offering, the equity pieces, they're necessary to fund the build-out. But the crucial thing now is that landing this huge CoreWeave contract likely makes raising this capital, especially the equity, much more palatable to the market. Why? Because investors can see exactly where the money is going towards building facilities for a contract that's already signed and projected to generate massive revenue. It's less speculative now.
You mentioned existing debt earlier. Did the sources give a sense of how much debt they were carrying before all this new financing?
Yeah, they did carry a substantial debt burden, as one source put it. Their Q3 FY25 report showed $689.1 million in total debt as of Feb 28, 2025. Another source mentioned a figure closer to $993 million, maybe reflecting a later calculation or different components. Managing that existing debt while taking on these large projects and new financing is definitely crucial. The hope, clearly, is that the strong future cash flows from CoreWeave will provide the means to service all this debt effectively.
Okay, let's zoom out again. Connect this massive deal back to their overall strategy. It feels like Applied Digital is really, truly leaning into the AI data center market now.
Oh, absolutely. This agreement with CoreWeave for 250 megawatts, specifically for AI capacity, it decisively advances and frankly solidifies that strategic focus. It really shifts their identity, moving them beyond maybe being primarily known for blockchain hosting in the past into a much more prominent role as an enabler of large-scale AI compute. It's described consistently as game-changing for their position in AI infrastructure.
So what are the key advantages they're highlighting? What makes them think they can compete effectively in this really hot AI space?
The sources list several things. One, they build purpose-built next-generation facilities. These aren't just old warehouses. They're designed specifically for the high power density and cooling needs of AI and HPC gear. Think 50 up to 150 kilowatts per rack, which is a lot. Two, they emphasize rapid deployment capabilities. Speed is critical for AI clients who need capacity urgently. Three, they focus on securing access to large-scale, low-cost power, often with a growing renewable component, using locations like North Dakota. Four, they use advanced liquid cooling, favoring direct chip solutions for efficiency. And five, their campuses are designed for scalability. Ellendale, for instance, has the potential to grow eventually up to 1 gigawatt.
So building specifically for AI, building fast, accessing cheap power, how does landing a major AI player like CoreWeave, known for getting the latest, greatest hardware, first, how does that position them against competitors? Maybe even others who pivoted from crypto, like Core Scientific.
Well, the sheer scale of this deal and the fact that it's a long-term contract with a specialized AI hyperscaler like CoreWeave gives APLD a massive validation point. It's a flagship deal. It signals to the market, hey, we can land the big fish, we can execute on these complex AI requirements. It really helps them stand out from, the big established data center REITs or even the cloud providers themselves. Getting CoreWeave, who surely had other options, as an anchor tenant is a key differentiator for them.
It sounds like it shifts the perception, maybe from being a bit under the radar or still tied to their crypto past to being seen as a more recognized, serious player in critical AI infrastructure.
I think that's exactly right. A contract of this magnitude fundamentally changes their business outlook and definitely their market visibility.
Okay, we've talked a lot about the huge upside, the strategic fit. But every big opportunity comes with risks. For you, the listener, what are the main risks here that need to be front and center?
The biggest one, and we keep coming back to it because it's so critical, is execution risk. Can Applied Digital actually deliver those 250 megawatts on time, meeting all specifications by those late 2025 and mid-2026 deadlines?
Because of that CoreWeave termination, right? If they've missed those dates.
Precisely. Construction delays, cost overruns eating into their funding, supply chain issues, although they say power is secured for these initial buildings, labor challenges, all those are major execution risks. And missing those delivery dates isn't just a setback. It carries that severe penalty, potentially losing billions in future revenue with no compensation. It's the primary risk.
And assuming they do build it on time, are there ongoing operational risks to worry about?
Oh yeah, absolutely. Over a 15-year contract, you bet. Ensuring consistent uptime, meeting those demanding customary service levels 247 for 15 years is a huge operational challenge in itself. Any significant failure could lead to service level credits, which are basically financial penalties they pay to CoreWeave. Beyond uptime, there's managing energy costs, physical security, cybersecurity, maintaining those advanced cooling systems, retaining the skilled staff needed to run everything, lots of ongoing operational risks.
Given how big this deal is compared to APLD's overall size, is there risk they become too reliant on just one customer, CoreWeave?
That's definitely a major risk. It's called client concentration. With potentially $467 million in average annual revenue coming from the single client, CoreWeave is going to represent a very, very substantial chunk of Applied Digital's total revenue, likely the majority, right? So if CoreWeave were to run into financial trouble down the road, or if their need for AI capacity changes dramatically, or if they decide to terminate for convenience, even with that fee, which we don't know the size of it, would have a huge material adverse effect on Applied Digital. It's the flip side of landing such a big anchor tenant.
That's a significant trade-off. What about broader market risks? Things outside this specific deal?
Sure. Their business is inherently sensitive to regional energy prices, even if they try to lock in rates. And while AI growth looks explosive right now, you can't rule out a broader economic downturn hurting demand, or maybe an unexpected slowdown in AI adoption impacting future capacity needs, or even CoreWeave's own business health.
The sources also mentioned high short interest in APLD stock. Why might investors be betting against the company? And how does APLD realistically counter that skepticism?
Yeah. High short interest, some sources pegged it over 25% of the float, means a significant number of investors are skeptical. That skepticism could come from their history of losses and cash burn, maybe doubts about their ability to execute these huge projects on time, concerns about their debt load, or maybe past issues like earnings misses or client delays they might have had. How do they fight it? Honestly, the best way is just to deliver. Execute flawlessly, complete the CoreWeave facilities on schedule, hit the revenue targets, transition to profitability and positive cash flow, manage their debt effectively. Results speak louder than words. Clear communication helps too, of course. And it's worth remembering, Applied Digital's vision goes beyond just these first two CoreWeave buildings at Ellendale.
Right. Are there plans for other big data center campuses in the works?
Yes, most notably, they're proposing another multi-billion-dollar AI data center project, this one located east of Toronto, but actually in Dual County, South Dakota. That project is envisioned for potentially up to 430 megawatts of IT capacity. They also have their existing facilities near Jamestown, North Dakota, some older crypto-focused ones, and a smaller, newer HPC site.
430 megawatts in South Dakota. Wow, that's comparable to, or maybe even larger than, the initial design capacity at Ellendale, which is 400 milliW, though Ellendale has that longer-term potential up to a gigawatt. That South Dakota plan shows serious ambition for scale.
It really does. And when you pair that with financing partners like McCory, whose facility could potentially support building over 2 gigawatts of capacity over time, well, their aspirations are clearly substantial.
And what about that potential REIT conversion mentioned in the sources? Is that still on the table?
Management has indicated they are actively considering converting the company into a real estate investment trust, or REIT. The main strategic reason would be to potentially lower their cost of capital for future building and attract investors who like stable income-producing assets, which data centers can be. The move to sell off their separate cloud services business is seen partly as preparing for that, simplifying their business model to be purely about owning and operating the physical infrastructure.
If they do become a REIT and they manage to become consistently profitable, does that usually mean they'd have to pay dividends?
Yes, generally. REITs have rules requiring them to distribute a large portion, typically at least 90% of their taxable income, to shareholders each year as dividends. So if they successfully convert and achieve sustained profitability, dividend payments would likely follow, assuming they meet all the requirements.
Okay. Were there any other important partnerships highlighted besides the huge CoreWeave deal?
Well, they have an existing relationship with Supermicro using their servers, especially in that cloud services business they're looking to sell. But maybe more significantly, NVIDIA was mentioned as a participant in a $160 million strategic financing round for Applied Digital back in March 2024.
Wait, NVIDIA invested in APLD, and CoreWeave is famously a huge NVIDIA customer, often getting their latest GPUs first. Is there a potential synergy there?
That's exactly the potential connection that gets interesting. Now, the sources confirm NVIDIA invested in APLD, but they don't explicitly say if NVIDIA is also an investor in CoreWeave, though it seems plausible given how closely they work together on hardware. But even just having NVIDIA as an investor in APLD could foster closer collaboration. Maybe it gives APLD and tenants like CoreWeave better, or earlier access to NVIDIA's newest AI chips, maybe opportunities to optimize the data center design specifically for NVIDIA tech. It strengthens their position within that critical NVIDIA AI ecosystem, potentially.
This has been a really deep dive, unpacking a super complex and potentially company-defining deal. For you, our listener, trying to make sense of it all, what are the absolute key things you need to watch going forward with APLD?
Yeah, if you boil it all down, connect it to the big picture. The success of this whole transformative deal really comes down to one word: execution. So the main milestones you need to track are all about their progress on the ground in Ellendale. First, can they hit those ready-for-service dates? Watch for updates on Building 2 in the second half of 2025, that Q4 target, and Building 3 in the first half of 2026, aiming for mid-year. Those deadlines are absolutely critical because of that termination risk. Second, once they're operational, can they consistently meet those high customary service levels CoreWeave requires? Keep an ear out for any mention of service level credits being paid out. That would be a red flag for performance issues.
Right. Delivery first, then consistent performance. What about the money side?
Definitely watch their financial reports very closely. You want to see evidence of that shift towards profitability and, importantly, positive free cash flow as revenue from these Ellendale buildings starts to ramp up. Also, keep an eye on how they're managing their debt load amidst all this expansion.
And what about growth beyond just this CoreWeave contract?
Yeah, look for news on whether they can sign up other large tenants, either for any remaining capacity at Ellendale or for these new developments like the proposed South Dakota campus.
Yeah.
The status of selling their cloud services business is also key. Does it close? And how much capital does it bring in? And longer term, watch for any concrete steps or official announcements about that potential REIT conversion.
Got it. So those are really the key signposts, the indicators that will tell us if Applied Digital can actually turn this massive $7 billion opportunity into sustained success and become a real force in AI infrastructure. So wrapping up, while this CoreWeave deal clearly paints a picture of a company with suddenly huge revenue visibility and a direct path into the red-hot AI infrastructure market, that path forward is, well, it's far from guaranteed, isn't it?
Not at all. It requires enormous capital, demands near-perfect execution under very tight, high-stakes deadlines, and involves managing significant risks like client concentration in a tough, competitive industry. The opportunity is immense, absolutely, but the challenges are equally real.
It really does feel like a high-stakes situation, like the entire near-term future of Applied Digital hinges on their ability to build these complex AI factories precisely when and how they promised CoreWeave. Well, that was quite the deep dive into this CoreWeave agreement and what it signifies for APLD. We've tried to unpack the huge numbers, the critical timelines, the risks involved, and also the exciting potential this unlocks for them in the AI space.
Yeah, hopefully this whole analysis gives you a clearer framework, a better understanding of all the moving pieces, and really pinpoints what you should focus on as Applied Digital moves through this potentially very transformative period.
Absolutely. And that brings us to a final provocative thought for you to consider. In a world that's absolutely starving for AI compute power, scrambling for every megawatt of capacity it can find, can Applied Digital build fast enough and flawlessly enough to truly seize the massive opportunity validated by this $7 billion contract? Or will those execution hurdles we talked about end up slowing their momentum, maybe opening the door wider for competitors?
Something definitely worth thinking about.